China only constitutes about 2% of the MSCI All World Index. For a 17.6 trillion economy, that is massive underinvestment from an equity market perspective. So over time, you're likely to see very significant inflows into China, which becomes more and more investable.
Hello, ladies and gentlemen. Welcome to our weekly tea break video session. I'm delighted to welcome our special guest to the studio, Yogi Dewan, CEO and founding partner at Hassium Asset Management, who previously served a 10-year stretch with Goldman Sachs, so he knows where at least some of the bodies are buried. Yogi, there's a lot to talk about this week. And firstly, what kind of tea have you chosen to drink there?
I've gone for tea that I have always enjoyed from being a child onwards. It's called a half and half. 50% English breakfast, so strong tea, and 50% Earl Grey for freshness. And I combine them, and that's what I drink all the time.
And that's a bit like your asset allocation philosophy, is it? Splitting between different sectors and combining them?
To an extent, but it's not used to manage risk.
Good. I'm glad to hear that. Now, I'm going for a nice cup of the Chinese green tea. And one of the reasons is because we had a very interesting article from Liu Jing at Value Partners in Hong Kong. And he's arguing that since last year's stimulus package, China is once more investable. And with Trump's US no longer a reliable partner, Beijing must seize this opportunity. Is that a sentiment that you agree with?
China is definitely investable, Yuri. It's a $17.6 trillion economy. If you add up all of Europe and the UK, you're still smaller than China. Obviously, the biggest economy is the US at 27 trillion. But China is growing at 5.4%, and it will continue to grow. And remember, growth has to be financed. It's not a freebie. It's financed usually through stimulus, fiscal spending, and bank lending, all of which you're starting to see in China. So at the moment, sentiment is very negative in China because of the Trump tariffs. Interestingly, only 2% of GDP is actually exported from China to the US, so we're not talking about big numbers. The tariff discussions, there will be a conclusion. There has to be out of economic necessity, and we've already seen signs of that today. But the other thing that's actually going on outside of all the stimulus, outside all of the growth in China, is the fact that China only constitutes about 2% of the MSCI All World Index. For a 17.6 trillion economy, that is massive underinvestment from an equity market perspective. So over time, you're likely to see very significant inflows into China, which becomes more and more investable.
We have had a slightly contrasting view from William Louis, who my colleague Elisa Travato interviewed. And he's the fourth generation head of the Kowloon Bus Company. He does not invest in China or any of the Asian so-called emerging markets. He feels that that part of the world is just much too speculative for the long-term family offices such as his. And despite all the talk of the New World Order, Yogi, he prefers to back the US and Europe for the long term. Can you see where he's coming from?
Yeah, of course you can. Look, the US is 65% of global equity markets. You add Europe, you get up towards 85%. So the world is actually US and Europe from an investable equity market perspective, not China and Asia. But China and Asia are growing. I saw a Goldman Sachs forecast looking at the biggest economies in 2075, so 50 years from now. And the biggest by quite a margin was China, then India, and then the US. It is quite hard for US, European investors to get exposure to China in a meaningful way. There's a lot of concentration risk within the Chinese equity markets, particularly around commodities, particularly around financial services, to a lesser extent tech. But things are changing. It is a region where a lot of investors are just scared. They're scared to get exposure, and they're scared to commit long-term capital to that region because of geopolitics, because of what's actually going on in that region. And that's made everybody just take a pause, wait to see what happens, see how things play out, and then they invest accordingly.
Do you see investors becoming scared of investing in the US as well? Because we had the piece from Nigel Green, and he's very much saying that the tariffs, they're not a sign of strength. They're a sign of weakness for the US, that the productivity is so low there compared to other regions.
So if you go back over the last 30 years, the S&P 500's done 10% on average every year. It's by far the best performing asset class and equity market that we have ever had. Has that come to an end? I think it's unlikely. I think, remember, it's earnings that drive share price appreciation, and we've got significant earnings numbers coming out and continuing to come out with revenue growth of around 5%, earnings growth of around 10% for 2025. The US economy isn't slowing down. There's a massive budget deficit that needs to be financed. Tariffs is a way to do that. We also have a trade deficit of around $1.2 trillion, i.e. the US is importing more than it is exporting. Over the next 12 months, we've got $7.6 trillion of government debt rolling. Trump doesn't want that rolling at 4.5%. He wants that rolling at 3%. So, of course, he wants to see the dollar weaker and rates lower, which is his narrative. And if he can pick up tariff revenue, that will help correct the deficit too. So you can see what Trump is trying to do, but he's not done it with much eloquence. And it's caused a lot of uncertainty. And the risk on trade now is around a US recession or stagflation. And that's the balancing act. Everyone's very accepting now of a 10% tariff. That's his baseline. It's almost a relief. And he turns around and he says, well, actually, we're going to reach an agreement with China out of economic necessity now. And the market rallies. We're on day 2 of a very significant rally. All the short covering has to be managed. Everybody's frantically trying to manage the VIX and volatility. And everyone's forgetting you need to be a long-term investor. And going back right to your initial question, is China a good opportunity? Of course it is. It's only 2% of the MSCI All World. It's growing at 5.4%. It's the second biggest economy in the world. It's robust economically. And it's transporting and exporting all over the world. If only 2% of GDP is being exported to the US, what about the rest of the world, which are all big beneficiaries of what China produces?
You've been very positive there about the US and about China. How about the UK? We had a piece by James Booger from Seraphim saying the UK really has to reinvent itself to attract investment. We saw a spurt of funds being launched in the defence industry, and he's talking about the space tech sphere in particular. Do you see the possibility of the UK becoming some kind of space defence superpower?
If I'm really honest, I think the UK's importance in the world economy is slowly diminishing. And I think that's a consequence of geopolitics and economic policy over decades. If you look at the defence sector, it's only 4% of the FTSE 100. If you look at the market capitalisation of the FTSE 100, it comes to about 3 trillion. That's the same market cap as Apple Computers. Apple Computers is bigger than the FTSE 100. Has it got the ability to be a superpower? It's really hard to see, based on how it's performing, based on economic policy. Remember I said growth has to be financed, fiscal spending, bank lending. We're not seeing a lot of that in the UK. We've got GDP growth of 1.5%. The US is at 2.5%. China is at 5.4%. It's struggling.
UBP, the Swiss bank, has chosen this as a moment to buy a struggling UK wealth manager, SG Hambros. Now, in my conversations with UBP in the past, Brexit has always been a major problem for any ambitions they've had in the UK market. But in the piece written by my colleague Ali, they've been very positive about the UK. Will they succeed with buying this franchise? Because a lot of other people have struggled with that particular bank.
UBP is an excellent bank. The Picciotto family have run it for decades, and they've done a very good job of it, and they're very good at reinventing themselves. However, why are they investing in the UK? I don't see the UK market wanting a private Swiss bank offering. And if you look at why they're actually doing this, my gut feel is that this is about acquiring assets that they can then channel into products where they generate higher margins. I don't think this is a strategic acquisition in the way many think. I think it's just more about distribution and commercial terms.
We'll invite you back 6 months down the line and look at some of these predictions that you've made. Absolutely. Well, thanks very much for joining me today for the tea break. And sadly, that's all we have time for ladies and gentlemen. I'm hoping that my colleague Ali Alanazi will be back on our beloved green sofas with me next week. Please do send in your questions. We'll be discussing technology and AI next week. So watch our episodes on PWM Net and our YouTube channel, and we look forward to seeing you for the next episode of our PWM Tea Break.